All right, we have hit the time in which we will do another roundtable segment with part of our crew here, Blue Chip, Chart Trader, Scalp Trader, and Event Trader. Going to welcome all you gentlemen in with a good morning.
Good morning, Jim. Howdy.
Morning.
And,
Hi, Jim.
And a howdy to you. All right, so I had a topic, but things are kind of cooking in the market a little bit today. You guys are pretty active, so it may not be all that relevant of a conversation, so I think we may table it for another day when markets slow down. That topic was going to be what you guys do when the markets are slow. Unfortunately, it's not really relevant, so let's hit on some of the more pertinent issues. And I have a question from a listener who wants to know, how come no one is shorting this move up? I'm going to start this one with Brett, Chart Trader.
Hey, Jim. Well, I mean, I may. So, I just need to see a setup come into place that I recognize and then I feel comfortable shorting. I'm not overly bearish on the market from here. I could become that way if the market shows me signals that suggest that I should be. One down move that's sharp through a level this morning doesn't really change the context of my mind, and the context is, as we've talked about quite a bit, this combination, a really tricky combination of overbought and underowned. And right now you're seeing the overbought come into play, but the underowned is still there. We still have a lot of data suggesting that there's a lot of folks who probably are going to be bidders on a pullback. And, if the character of the movement starts to show me that that may be a flawed idea of this market, a flawed conception, then I will become more bearish. And I want to see the way that the bounce evolves. If it starts to give me the type of pattern structure that I'm familiar with, I don't want to just see upward movement to short. That's if you just have a blanket bear bias, you're 100% positive that the market has to go lower, you maybe don't even want to set a stop, you just want to be short, then that's a different situation. I'm really never somebody who deals with the market that way. I need to see a defined setup that I recognize and that I understand in terms of its falsifiability, what it might do to tell me that I'm wrong, and that what falsifies it is a relatively small market change and something that I'm able to juxtapose with a target to the downside that makes sense in terms of the ratio between the two. So, if I see the type of tape that shows me there's big offer coming in and I see a falsifiability level and I see a good target, then I'll take the short.
Anybody else want to add into that? Maybe Gavin?
Yeah, I mean, the last two mornings, Jim, we were talking about leaning on the short side. I posted that comment yesterday morning discussing some of the reasons, and we'd been talking a lot about expecting a chop in this 2810 region, moving down to the 2750, which lined up around with the S&P. So recall, Jim, we were talking yesterday, and I was looking for a little bit more of a move towards the 2800 level. It didn't really happen. We were in the midst of moving higher when we were talking about it, and I was saying that I'd like to short that rally up, and it just never hit the level, so never hit the setup that I was looking for. And then today we talked about it a little bit too, in terms of I didn't like the idea of jumping into a short after being down 30 points in the S&P over the last couple of sessions, with us coming right into that 200-day moving average. I just didn't see a good risk reward there. I was looking more for a little bit of a bounce off the 200-day moving average to get short, short on that front. We got the jobs number tomorrow, and that could certainly play a big role in where we go. My ideal setup would be if we get a strong jobs number and we see a nice rally off of that, and then I think trying to short that rally might pay a little bit more dividends. But it was just tough. It didn't hit the setup yesterday, and today I didn't feel comfortable shorting coming into such a strong potential level of support with that 200-day.
All right, I think the key takeaway as to the answer to that question probably all the time, if one of the traders or all the traders aren't doing anything, is there's conditions in which these guys look for particular things to place a trade, be it sentiment readings or levels or the overall tone of the market. And if those conditions are not hit, they have the discipline to not pull the trigger on something just for the sake of doing it. The market getting a bounce it may look enticing to jump in, but if it doesn't meet the conditions in which these traders are comfortable, that in Brett's case, he can't find the falsifiability level, then he's not going to do anything. And I think that's being patient is the key takeaway on that. If we all had crystal balls, man, this market would be easy, but we don't, and therefore we are patient. So that's the answer to that question, I think. All right, let's jump into this BPTH. I ask it because we've gotten a ton of questions on it. I'm going to bring in Scalp Trader on this. Each time I look at this stock, I see the big H next to the ticker on my watch list here, which means it's getting halted. We started talking about this one a half hour ago, and the stock was trading 70. Asked Blue Chip Trader, yeah, I just stay away from this type of thing. Now it's down to 31. The volatility in this name is crazy. And Blue Chip did say, Scalp, if anybody would be interested in this, it would be you. I talked to you offline, and why don't you give me your comments on this?
Well, looking at it, there's really no theme involved. I try to stay away from just random biotech stocks that have news because there are a lot of momentum players that will jump into them, drive them up, but you really just never know when the music's going to stop playing. And companies like this, for example, this one is low on cash. They've issued warrants lately. I mean, you just never know when they're going to do a secondary. They're warrants that are getting exercised in real time. It's a real crapshoot. So, I mean, it looks good on paper, but you go out there and try to trade one of these things, you might get stuck in a halt and it gaps down 5 points or 10 points and then reverses back to the upside. You're chasing it again. I mean, really, what are your themes? Well, what's driving your interest in this other than the fact that it's going up? Ideal scenario for me is a name that's attracting, that has money on both sides, right? So you have the appeal of some momentum theme that, whether it be something like cannabis, right, where you have dozens of names that are running and there's a major theme, there's a lot of money pouring into that. Then you have people who are skeptical on the other side who are shorting that. So that, with those types of names that have money pressing both sides, you get consistent kind of ongoing volatility that becomes somewhat predictable, especially the short-term short squeezes off of pullbacks. And that's the type of thing I like to look at rather than one-off biotechs that you've never heard of, and you just don't know what's under the hood in terms of what may be coming down the pipeline in terms of offerings or warrant exercises or, news or fraud or, just all kinds of things. I tend to try to stay away from names like this.
All right, and let me just remind everyone that we typically do not cover stocks that are under 100 million market cap, even at this latest price, $31. It's only a $62 million market cap at this very moment. So coming into today, we wouldn't have covered it anyway. So again, if there's some sustainability to this name over the next couple of weeks and it gets interesting, maybe it's something Scalp Trader does some homework on and we get invested. These are one of those things, you'll be aggravated to no end if you think you missed out on an opportunity. Look for more high quality names instead of these lottery ticket plays, because you can get chopped up just as quickly as, and I guarantee you'll probably not make as much money as you end up losing if you try to day trade this one in and out. It's slippery, it gets halted, and really, who knows, it's a coin flip of where it's going to go on the very next reopening of this one. Anybody else have any other thoughts? Gavin, maybe? It's okay if you don't.
On the BHTP?
BPTH, yeah.
BPTH. No, I completely agree with Damon. I mean, just the area where he was talking about the marijuana names, for instance, and TRTC was a name that I got involved in. And, it's just kind of one of those broad, well, it's a marijuana name, it's got to go up. Looked at the numbers and everything looked great. But what I wasn't taking a closer look at was some of the warrants and the equity issuances that were coming down the line, and I got caught up in that. So, unless, like Damon said, this story, it's tough to just blindly buy something, especially when it runs this much, because you don't want to be the one caught holding the bag when this thing runs from 17 to 50, and then all of a sudden pulls a Red Sea and you're down at the 33 level again and you're scratching your head. Now, if you know the story and you know what's behind it, that's another thing. If you have an understanding, as David said again, on those warrants and equity issuances, then that allows you to at least handicap your risk on it. But again, just to buy something just because it's going up, I don't like doing that. I've gotten caught in the past trying to do that.
All right, so the next couple of questions we're going to focus on risk management, and the first one we're going to throw out there is, how do you decide where to place stops? I know it's contingent for each and every one of you, and probably by product as well, but Blue Chip, why don't we start with you in where you first assign a stop order?
All right, so again, I'm mostly a technical-based trader, so I typically it's a combination of things. It's not set in stone, so to speak, but it usually has to do with the volatility of the stock itself and where I get my entry point. So I am a big fan of average true range, ATR, which is an indicator that's found on most software packages. And essentially it's a average of the last couple of time periods. I typically look at a 5 or a 10 period ATR, and they're relatively close. Even if you use the default setting, which I think is 14, you're only talking about a point usually difference of ATR, so it's nothing horrible. But for me, that calculation, and it's a lot more complicated than you think. I think they actually they avoid inside days and whatnot, so it's definitely a looser range going on there. But that to me tells me the behavior of the stock over the last 5 periods or so, and that's all I really need to go off of. I tend to look at the ATR, and I don't use it to the exact penny. Again, I'm not trading stocks for nickels, dimes, and quarters. I'm looking at whole figures a lot. So something on CRM, I look at the 5-day average true range. It says it's $4.36 as of the last 5 sessions. So I typically will risk about $4. Maybe depending on how I feel my entry was on a trade, maybe I'll go to $3. Then I'll look at the intraday price action, and usually a 60-minute time frame. 60-minute time frame, you can usually identify a much clearer support and resistance level on an intraday basis, and then I'll just basically take an average of there depending on my entry point. So that's basically it. It's just a culmination of that. Average true range, and then combining it with where the most recent support and resistance levels are.
Blue Chip, before we jump off from you, does it have anything to do with where your target might end up being? Is it maybe a 2-to-1, 1-to-1? I know you've outlined this in the past, but does that play into your stop as well?
It does not. No, I typically, I'm under the assumption that I know everyone says, they always want to take a good risk-reward ratio. They always want to, look for that 3-to-1 or 5-to-1, payoff. Yeah, that makes sense. But for me, everyone has targets. You can always look at a chart price action and say, hey, this thing should get back up to there. But again, I don't make those types of predictive moves. I just look more for the initial risk on a trade, and then I manage it going forward. So when price, I basically start to scale out, and again, that's basically my whole MO, is to get in with a position, typically full size, but sometimes I'll go in with a half size depending on the volatility and whatnot, to get into a zone that I'm very interested in, that I think price is going to move away from. And as price starts to move in relationship to the ATR, so for example, if Salesforce started to move $3-4 away from my entry point, I would start scaling out a partial profit on that 1-to-1 ratio, and then tighten up my stop losses. And then if it goes 2 to 1 from my initial risk, then I'm scaling out a little bit more and tightening up my stop loss on the balance. And then if it goes 3 to 1, I'm scaling out a little bit more. And usually by that time, I'm well out of the trade. I'm well out of my initial position. I'm taking 2 partial profits, and it's just a matter of just sitting with it and keeping balance stops around break even, and then managing the trade going forward. So yeah, that's basically the best way I can describe it. I don't typically look for those high reward, low risk set-offs. I look more for just key support, resistance levels, about where I'm going to be wrong. I always look to see where I have to admit that I'm wrong and take the loss first. And then the profits usually just kind of work themselves out thereafter.
I know, Brett, chart trader, you probably have some interesting thoughts on this topic as well.
Yeah, so I think that it provides some reasonably interesting contrast with what Scott said, and it shows how, you know, everybody develops a style that works with their personality. And he typically looks for most setups at a longer time frame than I do, and that does definitely impact the situation. I do a lot of reasoning that has to do with pattern structure and tape reading. So my stops are usually, if I've got a sense of where I have larger pattern targets, like, you know, I came in this morning saying I think that we're definitely going to test 2750 in the S&P. That was when I was short last week in the S&P. I was looking for that to be an important target to take me out. But how I set the stop and how I understand whether or not something is a good setup in the first place is, as I watch the market trade, I will see certain dynamics come into the tape. I'll see certain large sellers. In the case of looking at a prospective short, for example, I'll see certain large sellers at work. I'll see the way the orders are coming through, and there's a zone that starts to build itself out. And I understand the way that it's behaving. It would appear as though there's a point in the pattern that it's just not able to clear. And if it clears just a little bit past that, leaves some transactions up there, and then immediately gets hit back down inside the prior range, kind of a doji effect. Doesn't need to be a doji, though. Just the way that the orders are translating through in the tape, you can see that there's kind of an area that can't be penetrated, and that we've even shaken out some people who were short by busting up through the stops and then immediately getting collapsed back down into the pattern. I can see that set of orders up there that transacted above a prior level and then a rejection, and I realized that if it moves back up through that point again, then the short side is going to be wrong. Right, that's a sign. That's sort of the failure of the failure idea, where you get kind of a little, really small time frame failed breakout inside of the context of like an hourly chart pattern that's got a bearish feel to it, and you get that kind of, you know, 3 or 5 minute chart little failed breakout inside of that context in a small bounce, and you see the sort of lead blanket offer feel setting up. Then a secondary violation of that same point is going to change the way that I feel about that tape. So that's where my stop goes. It's above that secondary point. And wherever the price is, however much that implies in terms of risk, I need to feel like, and somewhat contrasting with Scott, I do need to feel like my primary understanding of where the levels are that need to be checked on the downside is a reasonable multiple of that distance to that stop. And if all of those things match up, then I have a good setup and I put the trade on. So I want to see a sense of something that shouldn't be violated in the pattern if my conception of that market, in this case the idea of being a bear in the market, if my conception is right, that I want to have a short side bias, then there's no way it should move past that point. And however much distance that is to that point, then it's just taking a ratio to where I believe the major downside targets are. And if it looks like there's open field below and there's a relatively short distance to falsify my bias, then that's a good setup. And so that's always at work in how I'm judging what I'm watching. It's always about interpreting those kinds of relationships between price zones and in the context of watching the orders go through in the market. So there's a point where an action would definitely falsify my bias. That gives me the idea of a good setup. Just like Scott, I start out with immediately assuming this is going to go wrong and that it won't be that much of a loss, and that if it does roll over, then it's looking like something that can be really productive. Then that's the definition of a good setup. But it does start with setting that stop at a point where I don't believe the market can go.
Hey, Brett, let me jump in there. So this is Scott again. So I just want to ask you a question. So obviously, I think two key components there. So we both agree that we definitely approach it from a risk perspective first, and we don't actually
Correct.
let the reward, blind us and say, hey, you know what, this thing is down so much or up so much that it's got to retrace to this level, or et cetera. It's breaking out. It's got to go to that level. We try not to focus on the reward at first. We always try to look for that key entry point where it feels like a low risk, high reward payoff. But for me, like I said, I just don't put any sort of specific 3-to-1 parameter on it or 5-to-1 parameter for me to enter it. So there's a slight difference there. But the other thing, two questions I have for you too, and actually the other point that you made was we trade different vehicles. I mean, obviously you're way more of a futures trader and a major indice and larger asset, crude oil, gold type of player when they call for it, whereas I'm more of an individual stock name. So I think those definitely come into play with the different types of analysis because I'm always focusing on leadership qualities and sector rotation and relative strength, and I think those kind of inherently help me assess my risk on a lot of trades. Whereas with your futures trading, you're more day trading oriented, and like you said, I'm looking at much larger time frames, weekly, daily. I typically try not to drop below a 60-minute time frame. But what would you say your main time frame is that you really spend a lot of your time analyzing for futures trading?
So, I mean, I think that I analyze all time frames. I think I go all the way across the board. I have in front of me the monthly chart, the weekly chart, the daily chart, the 15-minute, the 9-minute, the 3-minute, and the 1-minute, all at the same time. So, to me, it's just like it's a puzzle. It's a jigsaw puzzle, and when things line up, I don't want to see a lot of conflict between time frames in terms of bias. I don't want to be bullish on the weekly chart, bearish on the daily chart, and bullish on the hourly chart. That's not a market I'm going to want to trade. So when I see things line up, but the other big point I think that comes into the analysis is when you're looking at, especially if you're looking at mid-cap individual equities, you don't have sentiment data, and that makes a big difference in terms of my bias. And when I have like the situation we have now, I keep calling this difficult situation of overbought and underowned, kind of makes me a lot less aggressive across the board. Even though the VIX is inching up a little bit, that means right now I'm going to focus on smaller time frames because I don't have a larger time frame bias, because we've got this, what I believe sets up perfectly for a range trade, possibly for a while in the market, because you've got to work through that overbought and underowned situation until one side or the other breaks in that equation. So if we get the VIX up, let's say we see a VIX of 19 or 20 on a breakdown to 2,700, then I'm going to be really trading on very short time frame charts because you're going to have wider ranges, at least for a period of a few days, and it's going to give me some really probably pretty easy opportunities to pick up 50 points, 70 points in the NQs here and there, just on small patterns, just over the course of 15 or 20 minutes. And that kind of market is I think really low-hanging fruit for me, and I'd like to see that. I enjoy that kind of process. But when the VIX is not there, I spend most of my time really trying to get a feel for what I want to see on the hourly chart or the daily chart to give me a sense of bias.
Gotcha. Yeah, again, volatility is a key issue. You got to take that into stride when assessing your size on a trade and assessing your risk on a trade. If you're struggling as a trader, my first assumption is always going to be that you're trading way too large or your stops are too tight. And the way to overcome that is outside of just stop trading, but the way to really kind of get back into consistently being profitable and being on that right side of the market is by, from my experience, reducing your share size and widening your stops. Your analysis is probably too tight for what you're comfortable trading, and until you build up your account and you see yourself consistently growing that account and getting in touch with the market and being able to capitalize on that management aspect of proper sizing and risk, you got to stay small, and then you got to basically earn the right to increase your size gradually, bigger and bigger, to comfort levels that you're that you can trade. Yeah. So
one point to add to that. I tend to, and this is because I've been doing this, for 20 years plus. I can give myself the leeway to do this, but I tend to trade larger when the VIX is higher, simply because, and I would encourage people to not necessarily do that, but to be open to the idea that it's kind of a strike while the iron is hot. If it is your style to approach top-down markets and to do better when volatility is higher, the one factor that I think makes money a little easier to make in that kind of market, given my methodology, is that there's just simply greater serial correlation. The market is more internally correlated to itself. The patterns are playing out in a more patterned way because people are reacting to each other more than they are making independent, separate, rational decisions. There's more of a herding aspect to the market when volatility is higher, and I find that the setups are a little bit more pure. And so my P&L over the course of a year is really powerfully augmented by the fact that when we do get periods of a high VIX, that's when I tend to make, many times as much money over a short period of time. Right. It's simply because I see these patterns really well. The first thing I do is I don't start off doing that. If we get a big VIX pop, I don't start immediately off just trading 3 times the size. I gradually build up to it as I start to feel like I'm in rhythm with the market. And when I start to feel like it's like a rhythm shooter, it's like if Steph Curry just gets hot from 3, he starts to feel it. Bang, bang, bang. It's just knocking them down. When I start to feel that way with the market, I know I'm really in sync with that crowd effect. I know that I'm one step ahead of that herd, and then I start to pyramid my size in the trades. And I would say that's been something that's been extraordinarily helpful to my success over time, the fact that I've had that approach. And I would be open to that rather than just being scared by the higher VIX. And that just fits well with my method. And if you guys out there, if you feel like you see the style that I trade, especially at those types of times, like we had in December, like we had last February, those sorts of periods, if you get a sense that that's kind of in your wheelhouse, then you definitely want to make sure that you take advantage of periods like that, because that's going to be what dictates the real difference in how you do over time, is that you really manage to strike while the iron is hot. So I think it really is, it comes down to, I think there's a lot of personality variables that come into trading success, and you need to have stylistic choices that fit well with who you are.
Right. And during those times of high volatility, and I've seen you increase your size, and the key thing that I've taken away from that, and you can answer this question too, is how quickly are you taking your loss during that period of high volatility? When you do actually realize, I know you're pinpointing your entry point, but are you sitting around and saying, oh, I'm going to just wait around because I took such a massive size?
No, I mean, my stops are in hard always.
Yeah,
so
exactly.
they're on the order ladder. I don't even have any say in it. If the market immediately violates my presumption about the pattern structure, I'm out immediately. I could be out in 20 seconds.
Right.
But if it's holding, and again, this is the idea of higher serial correlation. When you start to see a market that's really cooking like that, you see pattern rejections at a certain level, whether it's up or down. You get the sense that there's a big player involved, and there's a herd that's smashing against it, like waves crashing against a cliff shore. It's not going to move through this, and you see people starting to get out over their skis a bit. Let's say people are really looking for a bounce in a market that's been down a lot, and you see these spiky tails popping up through a level, but the market can't hold going through it in the context of a downward trend, and then it starts to roll over. Your stop's above that last tail. You've got a tight stop. The market starts to dive, make new lows, and extend through them as everybody who's been trying to buy for that bounce pukes it back out the other side. Those are some of the best and easiest trades, and you have to take advantage of them if you have this kind of style. But those signals in that tape will be much more pure, much more clean, and much more reliable when the VIX is at 25 or 35 than it is when the VIX is at 12.
Right. And
so, but my stops are in hard always.
Right, and that's 20 plus years of discipline of you figuring that out. And the key thing there, and I just have to reiterate this to anybody listening, that it's a fantastic style. It's a huge money maker. But if you sit there and start saying to yourself, well, I just took on this massive size, and it's going against me, and it's going to cost me X amount of commission, I just got into it, yeah, you're dead. You're a sitting duck. You're dead. You can't, there is no hesitation when you trade that type of methodology. And that's basically it. And like I just stated earlier, you have to earn in my experience, the right to increase your share size. Everybody should be starting off small, and then eventually, as time goes on, you gradually increase it when you feel like the conditions are right to do so. And if it doesn't work, you can't be a sitting duck. You gotta have that discipline. So yeah, good stuff. Yep.
Now, Damon, let me ask you, because I've seen in the past that you will fluctuate your stops, and you'll put in a stop at a particular level, and then you'll see the price move, and you'll adjust it if you add to a particular, I think YY you might have adjusted today. I think you did one yesterday. I can't remember exactly. But you do play the game of moving your stops. How do you decide that, and how do you determine when you do that?
Well, I'm normally just looking at price ranges and kind of the stock's short-term price behavior. So when I see a stock that's kind of fallen outside of its normal trading range, basically betting on a reversion to the mean. And so, I'm looking at, just looking at its peers, looking at the overall market, taking that all into perspective and thinking, I can make money on this stock. It's a matter of scaling in and making sure I give myself enough room to not get stopped out. So I don't want to set it up so that I'm, risking 30% or something, but I'm comfortable risking, say, an extra 30 cents or extra 50 cents or $2 of total risk. Maybe I started with a stop of $1.50. I'll adjust the stop down 30 or 40 cents. If I feel like, okay, this is getting a little extreme, I might actually want to even add a third position, because typically I scale in half. So yesterday, I think, for example, I mentioned, I think it was Huya I was trading, that I saw half, I scaled in a second half, then I adjusted my stops lower, put out a comment saying, I'll buy another half if this thing hits a certain point. Didn't quite get to that area that allowed me to get that third half on, but I was pretty comfortable that I was going to make money on that. And, personally, a lot of times as the price gets further away from my initial entry, I'm typically increasing my size on those. That's not something that that I would suggest that everyone do, but that's my approach in terms of, if I like it at one price, I'm often loving it at a lower price. It may, just get larger position down there so that when it does bounce, I don't need that full move to make it a winner.
All right, and Gavin, any thoughts on this topic?
Well, I had the Resi before, so kind of laying out that one there. I know there was a few questions people liked the trade, but thought that perhaps I might have had to stop too tight. The way I looked at it is when I'm putting in stops, I definitely want to have support levels that if they're broken, then I'm quickly, I'll see that I'm wrong, the falsifiability that Brett always talks about, and that's a lot of the times where I'll be placing my stops with targets on a key technical level above that, and it's usually based off of either price action or some fundamental reasoning for it. The Resi, I wanted to keep a little bit tighter, just because, number one, overall markets will certainly have an issue, will play a factor into where I put stops. For instance, Resi, a little bit more of a volatile name, that in a market like this where we're seeing selling pressure, if I'm getting long, this is one that could easily be sold off pretty quickly. And given that it broke below the 20 level, I wanted to keep my shorts a little bit tighter. So I'll certainly be looking at each one on a case-by-case basis, but I usually look for around that 2-to-1 risk reward, and I look for a good level to buy where there will be a support level shortly below it, where if I am wrong, I'll be quickly found out and minimize the downside risk.
All right, so sticking to the money management theme, I'm going to ask one, how much open profit are you willing to give back before you close out a position? For example, would it be if you get 10%, would you sell the position if it pulls back 5%, or to break even? Give us some rules of thumb. Anyone can jump in.
Quick question. I'm just making sure I got this correct, Jim. So is the person asking if we're in a swing position, we get up 10%? When do we know we're taking profits?
Well, I think that's more of an example versus versus something concrete. I guess what is the level in which you are willing to give back profit? Are you willing to lose profit once you already have it established? Is there some threshold or rules of thumb that you're looking at? Scott, maybe you're a good one to lead off with in this particular one.
Right. So again, it's a case-by-case basis. So this is a really difficult question, I think, to answer.
Well, don't get caught up in the specifics. Just generalized.
Okay. So I'll just use something as a recent example. So I got along Amazon right at the end of February, based upon the tight consolidation for the last 2 weeks, and then it started to probe above the 1650, 1655 area for this potential breakout that I saw. So I got involved in that. And I paid off with the recent pop here over 1700 for about about a 50-point gain. All right. I obviously scaled out profits into the upside, and then as a swing trader, for me, I have that the remaining piece after I've taken 2 partial profits is, I hate to say negligible, but it's fun money. And it's the money that I just sit with, and it's in my account, and it's like, you know what, if this thing continues to run over up to 1750, 1800, well, I'm going to capitalize on it, and I virtually don't even have to do anything. The market's going to take care of it for me. At the same time, here I am, 2 days later, it's basically gone right back to my break-even point, and I'm not panicking out of it or anything like that, because I've taken a big chunk off, and it's a small little negligible, piece left. It's starting to eat into the partial profits I took on the way up, which is always a concern, and I'm probably going to close it out here before the close, unless there's some massive turnaround play in this afternoon. But for me, it's not again, after it depends on where I am in the trade. If I took 2 partial profits and I'm carrying that last small quarter size, I just let that run for as long as I possibly can, and I'm willing to let it go back. And again, it depends on your account size, depends on your horizon, your goals. There's so much going on that it's just a very difficult place. It's a way to answer that question, I think. I know some people hate that strategy. They will never do what I do and let this position run. But again, for me, it's like, I've been long BABA, for the last 3 weeks on that breakout over 170. Granted, the remaining gains in the last $4 or $5 have been on a small position size, but to me, that's just the comfort level I like to participate in at this stage of the game until it resets again. So hopefully that answers the question.
Can I follow Scott? Because I just want to add one dimension to that, but I use the exact same methodology. A lot of times on a shorter time frame, but the idea, and I think that I can add one more dimension to it, because I spent a long time testing trading systems, automated systems, and one of the important things that happen when you do that, and this was a long time ago, maybe close to 2 decades ago, but I did a lot of writing programs and testing in different environments and across different asset classes, and one of the benefits is you get this readout when you test a system over a time period that shows you all of the individual trades that were taken and all of the different trade outcomes, and then shows you the net result in terms of aggregate output, like how that system performed over that period in that particular asset class. And one of the things that you learn pretty quickly is that most of the gains in a trading system that works very well, most of the gains, remarkably, even if it seems like a consistent and frequently traded system, most of the gains tend to come from a very small percentage of the trades. And it comes from letting it run. It is when you have that piece that he's talking about and it just explodes for you. That ends up accounting for a remarkable share of the output of a trading approach. And in real time, instance to instance, it doesn't feel like that when you're taking the trades, when you're putting them in your account. And you sense that. I had a great example last week. I had a NASDAQ short, NQ short, where I ended up scalping. I was out of half the position for 50 points in the money, and I let the whole thing come back for minus 3 points. But I still made thousands of dollars on that trade, because having half the position out for 50 points was much more important than having the rest of the position out for -3 points when it all comes down to it. But if I had held on to that position, if the market had turned last Friday rather than earlier this week, I would be up several hundred points on the other side of that position. And it's some share of the sample of your experience, that's going to happen. And if you make a habit of trying to rip those points off the table because you don't want to give back those 50 points, then you're never going to get the 300, 400, 500 point moves. You're never going to get that extension, and that extension is worth so much more than just protecting that smaller gain on that position. I think that what I would call it is a telescopic methodology. I have an inside, intermediate, and outside target zone, and I definitely need to bank the partials so that when it does come back, I've still got a profitable trade in something that I understood was going to work on a shorter time frame. But I also understand that over the large sample, over any given 100 trades or any given 1,000 trades, that the biggest output, the biggest productivity that I can have is actually from those small handful where that last piece really runs like crazy. And it's really important to allow that possibility to exist if that's your style. Maybe you want to be scalping everything. Maybe that's your approach, but you understand that that's what you're giving up, and the benefit is seldom seen, but it's super powerful when it does happen. And it's tough to think in those terms, those smaller percentage but super productive elements of a sample.
All right. Anyone else want to jump in on this?
Yeah, I'll add to this. I mean, for me personally, excuse me, just over the years, seeing the names of people say if I could, I once owned Amazon when it was $10, or this stock when it was dramatically lower. I mean, for me personally, that actually impacted me a great deal. I mean, looking back over the years, all the names that I've owned that have gone up hundreds of percent or thousands of percent that I left on the table because I was being too aggressive in terms of trimming the position. So I know I've transitioned my style on the swing side to I'll often hold names for an extended period. So even as I'm scaling out, I may be out of 75% of a position, but that last quarter I may just continue to hold on to. And then you get to the point where, just last week, for example, been owning the stock ONCE for, I don't know, a year and a half or so. Over the weekend, news comes out, they're getting acquired by, I don't know, Genentech or someone for 120, 130% premium. Well, at this point, I've held that long enough. It's long-term capital gains versus short-term capital gains. I basically forgotten about the position, hadn't really paid attention to it. And, you get a winner like that that's just completely unexpected. I just went through and looked at my portfolio and counted. I have a dozen names that are up over 100% from the time I bought them. And, it's over 1 year or 3 years or 4 years. But, again, these winners, these names that you buy that you think have a compelling story. I'm all about taking profits, but you can have some real success by just holding on to a piece of this after you get well into the money and just seeing where it takes you. I'm always surprised by names that I see that I thought maybe this has had a double in it, and then you look a year later and it's up 5x.
Yeah, I'd just like to add too, you kind of have to have an idea in your mind what kind of investment is this going to be. If you look at when I post my portfolio, and anybody interested, you can look it up through the focus ticker for all our portfolios. There's some names that I've held for a few years. Google from 700, Bank of America from 13, and it's always tempting when you see it moving in towards a level where you're like, this was my initial target. But, the price action kind of remains strong, and you're just, you don't want to just cut something out just because it hits that initial target. Now, taking a few profits here and there, like Brett was talking about, that works too. But, you do have to let some of these run, and it also has to come down to what was your reason for buying it. Was it a long-term investment thesis? In which case, if the story's still intact, and the stock price and the stock actions in your favor, they're the ones that will generally tend to run a little bit further. And you just have to have the patience and hold in and just continue to trust that the investment thesis that you did and the follow-ups and looking at the earnings reports, they all play into, hey, this is still a strong stock with some upside. But again, if you're hitting some of those targets, then taking a little bit off the table isn't a bad thing. It reduces your risk. I know Scott does a lot with the trimming and trailing. That's another action that you could take in order to avoid giving back some of the moves. But really, you have to have kind of a defined length of your trade too, and you can't just be day trading everything just because maybe you get a move up into a key level where you're thinking, well, this is probably going to roll over. You kind of have to deal with that a little bit as long as that fundamental thesis is still intact.
And I think the last thing that you really have to take into account is whatever you do decide on that, because your opinion could change, you have to know that you're going to be comfortable living with it. And if you take off a trade and you look back at it 6 months later, if you're going to be okay with this thing trading twice as high as it is right now, then you probably made the right decision, so long as you have everything, your expectations in check. I think where we get lost in this conversation, gentlemen, is when you reassess that situation and the game has changed. You buy a stock at 20 and you're like at 50 and you're like, this thing, well, now this thing could get to 100. I'm seeing these analysts come out with a price target change. What do you do then?
You sell. Plain and simple.
Well, see, that's where we get caught up in the trap as traders, because things change and our opinions change, and what happened 2 weeks ago may be completely different now than it is now that we're looking forward. And this earnings came out, and we've got guys on briefing saying, "Oh, I really think this thing can run now that we got above the 200-day moving average." So the dynamics of that particular trade changes, and that's where we get in that conundrum.
Yeah, I mean, I think you have to be able to do, well, personally, able to do the fundamental work on that type of name as well. So, for example, I've been following this TTD that Craig has been talking about for a couple years now, and I've added several times, even after earnings, just because the story has continued to play out as he expected. And at one point, I trimmed most of my position. Took profits into the upside, but after each earnings report, the story just kind of gets better and better. And looking at the valuation relative to other software, it's not a compelling valuation, but just with the growth story, their total addressable market opportunity, the story just gets more intriguing. So, I typically like to buy pullbacks and build a position, increase size into weakness. If there's a story that I feel the market has undervalued, I will add to a position even if that initial position is already well into the money. But again, it comes down to being able to do that fundamental work on the name.
Right, and if another one on that front, Damon, on the flip side would be this NIO, where we had a nice move up, was making that move up through 10, came out with earnings, and they just had a horrible commentary around demand for the next 2 quarters. So we went from a pretty nice looking China subsidies driving an electric vehicle market to all of a sudden nobody's looking to buy this car, and that's when you head to the exits there. I gave up some of the gains post earnings on that move, but I didn't stick around with it because fundamentally the story had broken down. So I was willing to step to the sidelines.
I want to make one final point. You're never going to do this thing perfect. You're never going to achieve the goal perfectly in every instance. There's always going to be tons of examples where you left money on the table or you shouldn't have held on to something. You need to really think in terms of a large sample size, and you really need to assume that there's going to be a lot of imperfection there, but have a reasonable set of principles that gives you some percentage marginal edge on this dynamic.
All right, well said. Well, why don't we wrap it up on that note. Gentlemen, I can't thank you guys enough for joining us again today. It seems to be a really popular segment. We get lots of good feedback from everybody. We've got questions that we still have left. Unfortunately, we can't get to them all. but it does definitely give us some conversational points throughout the rest of the week. And when we get you guys on, we'll try to jump in and get some of these questions answered. And if not, next week we'll be back, probably same bat time, same bat channel. Sound good, gentlemen?
Sounds good.
Sounds good.
All
That's
right.
good, Jim.
Thank you so much. We should have this recording out for everyone who might have missed it, or if you want to hear it all again, that should be available probably a little later this afternoon. So we'll keep our fingers crossed, make sure we don't have any technical hiccups, but from what I can see, it looks like we should be having that ready to go in a little later this afternoon. So thank you to all the listeners who came in with these good questions. Spent a lot of time on risk management, and I think that's very well deserved because it's a very crucial point for trading. Hope you all got a lot out of that. Again, hopefully you can listen to it again, and any feedback, questions, hit that talk to us button. We've got all the guys still on here, so maybe if it's a compelling question that they need to jump in and give some color on, they may just do that as the day progresses. So thank you to everyone once again.